welcome to the Explainer. All right, today we are digging into two stocks that, let's be honest, everyone has an opinion on: Tesla and Palantir. You know, as we get deeper into 2026, both of them are what you'd call priced for perfection. But here's the twist: it's for totally different reasons. So let's unpack why they're both staring down a massive reality check.
Okay, so right off the bat, you've got to ask, what in the world does a car maker have in common with a spy tech firm? I mean, on the surface, absolutely nothing, right? One is all about sleek, futuristic cars, and the other is building this super complex software for governments and spy agencies. But if you look just a little bit closer, you'll see they share this one really risky problem. And it's a problem that could seriously shape where they go from here.
And this is where the plot really thickens. I mean, look at this. Their actual business performance, they're going in completely opposite directions. You've got Tesla over here dealing with slowing sales and profits taking a hit. And then on the other side, Palantir is just crushing it. Sales are surging, profits are at record highs. It's a total tale of two different realities.
Okay, so that brings us to the central question, the big paradox we're going to unpack. If one is struggling and the other is thriving, why on earth are they both facing a huge reality check? Well, it's because the market, it's priced both of them for absolute flawless perfection. There's literally no room for error. We're talking one tiny misstep, one little stumble, and their stocks could go into a free fall.
So, how did we even get to this point? To really get a handle on these insane valuations, you have to look at who's behind the wheel, who's actually buying and driving these stocks. And honestly, the answer, it's probably not who you think.
Wow, okay, this chart right here pretty much says it all. Just look at Tesla. Only about 48% of its stock is owned by the big players, the large institutions. Now compare that to a behemoth like Meta. A whopping 77% of their stock is institutionally owned. That is a massive, massive difference.
So what does that actually mean? Well, it means a giant portion of Tesla stock is held by everyday individual investors like you and me. And for a lot of these folks, it's not just about crunching the numbers on a spreadsheet. No, it's about buying into a story, a grand vision of the future. And that kind of passion, that belief, it can keep a stock price floating way up high, even when the fundamentals maybe don't quite support it.
And guess what? It's the exact same playbook with Palantir. You can see right here, its institutional ownership is way lower than other big tech names like AMD or MasterCard. So what does that tell us? It tells us that, just like with Tesla, the retail investor army is a huge, huge force here.
All right, let's switch gears and focus on Tesla, because this is where that powerful, world-changing story starts to run into a bit of a speed bump. A speed bump made of some pretty hard and, let's be honest, kind of concerning numbers.
And this quote from fund manager Gary Black really just hits the nail on the head. He's saying, look, you can have a stock trading at a valuation like a red-hot software company if your main business, selling electric cars, is actually slowing down. The stock is priced for explosive growth, but the actual car sales are hitting a wall. That's a really dangerous mix.
And here is the hard number that's got Wall Street buzzing, and not in a good way. A 16% drop in vehicle deliveries compared to the year before. I mean, for a company whose entire story is built on insane, breakneck growth, a number like that is a massive red flag.
And it's not just about the number of cars they're selling. It's hitting the bottom line, too. This chart shows what Wall Street analysts are expecting for profits, and it's a pretty steep drop, from 73 cents a share all the way down to 44. Plain and simple, the company is just making less money.
And just to throw a little more fuel on the fire, the competition is getting fierce. You have companies like BYD out of China who are not just catching up on sales volume, they're actually getting more profitable. At the exact same time, Tesla's profits are going the other way. That is not a good look.
Even the big, long-term promise, the thing that justifies the crazy valuation, is hitting some trouble. We're talking about full self-driving. Users are actually reporting some really serious, even outrageously dangerous issues with the newest version. And this is a huge deal. FSD is supposed to be the ace up their sleeve, the magic that makes them a tech company, not just a car company.
Okay, so let's pivot now and talk about Palantir. They're facing a totally different beast of a problem, but it's just as tricky. See, their business is actually firing on all cylinders, doing great. The problem, their stock price has gone, it's gone ballistic, basically. It's shot so far ahead that it's created this bizarre valuation paradox.
Just look at this breakdown. We're putting Palantir head-to-head with Nvidia, which is, the undisputed king of the AI chip world. And what you see is that Nvidia is actually more profitable. Yet, when you look at how the stocks are valued, things like the price-to-sales ratio, Palantir is trading at multiples that are just in another universe. That's the paradox right there. The numbers don't seem to justify the price tag.
And this comment from Reddit, it just perfectly captures the mindset. Someone says it's going up on hopium, and that the smart move is to ride the bubble, not run from it. For a lot of folks, it's not about the fundamental performance anymore. It's all about momentum. The fear of missing out is real. And they're not trying to avoid a bubble, they're trying to surf.
But the professional analysts on Wall Street, they're looking at this and seeing something completely different. They see this huge widening gap between how the company is actually doing and where the stock is priced. And to them, that screams one thing: a classic bubble.
And yes, some of these predictions are pretty stark. You've got the Motley Fool saying that 2026 could be the year the music stops, the year the bubble finally pops, potentially sending the stock price way, way down.
So this all leads us to the final showdown, the big reckoning for both of these companies in 2026. And what it really boils down to is a classic fight, the powerful, exciting story versus the cold, hard numbers on the spreadsheet.
I mean, let's give credit where it's due. For years, the story has been more than enough. Both Tesla and Palantir have made investors a ton of money by selling them this incredible, powerful vision of what the future could be. That narrative, that story of changing the world, it's been pure rocket fuel for their stocks.
But now, that powerful narrative is on a collision course with the numbers. For Tesla, the big question is, can the dream of AI and robots overcome the reality of their slowing car business? And for Palantir, it's whether the incredible hype can continue to prop up a valuation that just seems to defy gravity. As we move deeper into 2026, something's got to give. The ultimate question is, which one bends first, the story or the spreadsheet?